Okay, so in this video, we're going to run through investment property cash flow and why it's critical to understand the net cash flow position of an investment property prior to buying it. Hi, thanks for sparing some time to watch this video. My name's Tim. I'm a property investment advisor, property investment educator and a property investor. Now, when I'm working with my clients, or indeed if I'm looking to assess a property for myself, this is an area where we apply a fair bit of importance. So we talk about cash flow being the lifeblood of any business, and certainly when we're looking at a property or a property as an investment, then we need to apply the same principles. So the cash flow position of a property will be critical to understand prior to acquiring the property, obviously, so then we can match it back with our affordability. So there's no point spending the time finding a property, finding a tenant, gaining finance, just to find out that once we've purchased that property, we can't actually afford it, we have to sell it. So property investment as a strategy is absolutely fantastic. You look at anybody who's successful, they've got property within their wealth creation strategy. So it's not property investment, it's how we go about doing it. So like anything, we need to do some planning just to make sure that we put ourselves in a position where we can see that journey out. And we talk about cash flow being the measurement of affordability, and then the capital gain being the reward for being able to sustain that strategy. And then we choose to exit that strategy at the time that we think is right. But we need to be in that journey to be able to achieve those capital gains and reward for being sensible investors and being responsible investors. So within this video, we're going to look at some components of what goes into determining the cash flow position of a property. We're going to look at then, well, once we've established the cash flow position, how do we define that? And then also we'll go through some examples and look at what factors within the cash flow calculation influence or affect that end result. So you'll see the list here of those factors. First one, and these are in no particular order, but the first one I have is the purchase price, which is pretty straightforward. Whatever you're going to pay, or the advertised price if you're doing a quick calculation to assess a particular investment property that you've found. Secondly, the loan amount. Now, this will be the total loan that was required to acquire this property. So if you have a small line of credit, for example, against your own home, the house you live in, that was used to pay for deposits and perhaps the purchase costs, and then a separate loan that's secured against the investment property itself, then both those loans together need to be considered. The interest rate, so again, whatever interest rate you're paying against the loan required again or raised to fund the purchase of the property. Annual expenses, so they're the costs associated with maintaining, as they say, an income-producing asset, which an investment property is. The rental income, so that's what the tenants pay us per year, per week to live in our property. And the marginal tax rate, so that would be your marginal tax rate. The last one on the list there is depreciation. So to find that figure to enter into a calculator, particularly if you're doing, again, just an assessment of a property, then a company like BMT, who are quantity surveyors, on their website they have a calculator that if you use that, you basically just input the details of the property that you're considering, and that will give you a figure that you can use in the calculator. And the depreciation amount will be higher for newer properties and therefore lower for established properties or older properties. So they're the factors that we need to consider when determining the cash flow position of an investment property. Okay, so let's have a look at some cash flow calculations as examples. Before we do that, it's an obvious thing to say, but a lot of people don't pick up on this, or they go about it the wrong way. So first of all, before we do the calculation on a property, we need to know why we're doing this and what that number end result means to us. So effectively, if I work through a calculation for myself and determine, as an example, that I have, say, $100 a week surplus that I'm willing to allocate towards supporting an investment property, then if I perform a cash flow calculation on a particular investment property and it end result is, say, $200 negative a week, then I know straight away that I don't need to spend any more time on that property. It's going to be very, very difficult to tweak whatever I need to bring that back into my level of affordability. If it comes in at, say, minus $20 a week, then I know I'm well within that affordability range. So important to understand where we are first before we go and calculate perform the calculation. Now, you might want to just perform calculations to get an understanding, do some practice, but ultimately at the end of the day, we'll need to have a very good indication of where we are, where the property is, and does that come together and work to meet what we feel comfortable with. So the other thing I want to explain really quickly is that with the calculations and with the calculator, often what we'll do, what I do particularly, is work through really quickly to get an understanding, very good understanding of where that property sits without performing, really detailed calculations, if you like, because there will be some figures that we don't get 100% right, or we just can't get dollar perfect to start with. So we can use the calculator as a guide, and that would be a very good guide, and then it'll allow us then to make a decision as to, look, do I spend any more time on this property, or do I walk away and move on to another property? So just before we go into this next section, I just wanted to point out that we can perform these calculations fairly quickly, and you will also get a very good understanding quite quickly of the sort of rent return you need from any particular purchase price. That will then work to your affordability position. So you'll learn as we do anything, like we do anything, you'll get a bit of a feel for the combination of rental return versus the purchase price. So let's go and have a look at some examples now. Now, once we've calculated the cash flow position of a particular investment property, the cash flow position, the end result would be represented in one of three ways. So first of all, we can have a negatively geared property that has ultimately a negative net cash flow position. So there's a cost associated with holding that property. So as we can see there, costs exceed gross income and tax deductions are not great enough to cover the shortfall. So we'll need to cover that shortfall out of our personal income, our savings. So it is a property that will cost us to hold. The second one is a negatively geared property again. However, it has a positive net cash flow position, so there's a profit there. So it's actually putting money into our pocket from that calculation based on its position. So the costs exceed gross income. However, the tax deductions are great enough to cover the shortfall. So by including the tax deductions, basically it spins that property into being positive cash flow again and again. Therefore, is actually, rather than us having to support that property, it's actually supporting itself plus a profit. And the third one is positively geared. So that's a profit position again. And with that scenario, basically the net income exceeds costs. So purely the rental income is greater than all the costs associated with holding that investment property. And so therefore the tax deductions are not even required to spin that property into a positive cash flow position. So they're the three positions a property can be in as regarding cash flow. So negatively geared can be represented as a negative net cash flow position or a positive net cash flow position. And then there's a positively geared property, which basically, again, has a situation such that the income itself covers all those costs associated with holding a property. It's really difficult to find positively geared properties. Best chance of getting a positively geared property is when interest rates are very low. Higher interest rates make it very, very difficult to find a positively geared property. Negatively geared property with a positive net cash flow position. Again, once you get up around or higher than 7% interest rates, it becomes more and more difficult to find positive net cash flow properties as well. The next example, we'll use the same purchase price, $400,000. So it's exactly the same scenario, except this time we're going to increase the rent from $400 a week to $450 a week, and let's see what that does to the actual cash flow position. So everything else will remain the same as per the first example. So if we look now, so that $50 increase a week in the rental income basically takes that cash flow position up to approximately $134 positive a week. Okay, so for the third example, we'll keep the purchase price at $400,000, and what we're going to do this time is we're going to increase the interest rate from 3% to 4% and see what effect that has on the net cash flow position. So again, everything will remain the same. The rent is at $450 a week. Just going to increase that interest rate by 1%. So effectively what that does is it reduces the cash flow position by approximately $54 a week. All right, so let's play around with the interest rate. Let's take it right up to 8%. So again, $400,000 purchase, $450 per week rent, but an increase of the interest rate to 8%. And we will then see what effect that has on the net cash flow position of the property. So we'll come to that now. So effectively, that has reduced the cash flow position down to approximately $138 out of pocket a week, or a negative cash flow position of $138 per week. So that figure, or that amount, or that shortfall will need to be funded from our personal income. So on the left-hand side there, we can see at 3%, we had $134 positive cash flow position a week. At 4%, going up 1% in the interest rate, that reduced it to $80 per week, but it was still positive. Taking the interest rate right up to 8%, then reduce that weekly cash flow position to a negative amount of $138. So interest rate plays a big part on the cash flow position, or the net cash flow position of an investment property. Okay, so if we perform this calculation and we find that the net result is very close to our line in the sand position as far as portability goes, then there's a few things available to us that may work to bring that cash flow position back down and meet our affordability. So one option we may have is to negotiate on the purchase price. So in these examples, we've used $400,000. It may be that if we reduce that purchase price from $400 down to $380, then that actually works. And again, that cash flow position is workable for us. Another option would be to just check the rent that we're using. So it may be that we've come up with a figure of $400 a week, but in fact, after it may be that we spend a little bit of time doing a little bit more research, speaking to some local property managers, and if that rent is a little bit low, then obviously an increase in the rental return will also improve the cash flow position. And also we do have the option of fixing our loans in. So that may be one way of also just making sure that if the cash flow position is closed, we really don't want that to blow out any more than it is, then an option may be to speak to your broker or your bank to look at the option of fixing that rate in, so you know that that's not going to affect the cash flow position of that property and obviously affordability for some time. So, and it could be all those things. We may be able to make all that happen, which will then add another level of security to us and another level of confidence, knowing that we can then sustain that property and it will meet our affordability position, and then we don't have to do anything silly like sell a property that we've worked so hard to secure. Okay, so I'm just going to include this little segment in this video as well. It's because when we're speaking about property, you often hear the term yield used. So I just want to spend a little bit of time showing the difference between yield and cash flow, and to show that they are two different things, and also too that you can be told that a property has a very strong yield, but that doesn't mean that the cash flow is going to be strong at the same time. So they are two different things, and we just want to make sure that we are aware of what that looks like. So we'll go in and now and have a look and work through an example of yield versus cash flow. All right, so yield versus cash flow. So on the left-hand side there in purple, we can see yield, and beneath that we have property. So in both these scenarios, for the yield and the cash flow, we're going to consider a purchase price of $400,000 and a weekly rent return of $550. So again, if we say on the left-hand side under yield, the yield is actually calculated by determining the annual rent and then dividing that figure by the purchase price, then multiplying by 100 to give us a percentage. So the $400,000 property with a rental income of $550 a week will basically have a yield of 7.15%. Now, as we discussed, if someone said I've got an investment property that's yielding just over 7%, you would think, gee, that's really good. That's a very strong yielding property. But as we can see, yield and cash flow are two different things. So on the right-hand side under cash flow, we've got two properties, property one, property two in the light blue there. So again, we're going to stay with the $400,000 purchase price and the $550 weekly rent return and an interest rate of 9%. So the yield only considers the purchase price and the rent. Nothing else is used to determine a yield of a property. However, with the cash flow, as we've seen, there is more factors involved with then determining what the net cash flow position of an investment property will be. So $400,000 purchase price, $550 rent received per week, 9% interest rate. What we're going to do is change it up by having property one have a first year depreciation amount of $15,000, so a newer property, versus property two, which has a first year depreciation figure of $3,000. So if we drop below the green line there, we can see the weekly cash flow position for property one would be negative $147 a week, and for property two would be negative $222 a week. So we have to be really careful when we're talking yield, because it doesn't include a lot of those factors that really we need to include to get a more accurate determination of whether that property is something we can sustain and has a cash flow position that meets our affordability. So just going through that exercise to show the difference between yield and cash flow and how cash flow can, so in this example, a strong yielding property that has quite a negative cash flow position based on including those other factors that show us exactly how that's going to relate to our affordability. So it may look great from a yield point of view, but from a cash flow point of view, it may not work to our position that we can sustain that property and hold it within our portfolio for extended period of time. So a big difference between yield and cash flow, or can be a big difference between yield and cash flow. Now, I just wanted to add in here just to show the effect, again, of a change in interest rate. Even if we consider the older property with the $3,000 first year depreciation figure, with an interest rate of 3% versus the 9% that we use in this example, that will increase the cash flow position of the property to a positive $150 a week. So from negative $222 a week at a 9% interest rate to positive $150 per week, reducing that interest rate to 3%. So again, this illustrates how much an effect interest rate has on the net cash flow position of a property. And again, the interest rate has no bearing on the yield of a property. Okay, so I hope you're still with me. I didn't send you asleep. The numbers can be a little bit daunting sometimes, but it's like anything with practice. It becomes quite straightforward and calculations can be done very, very quickly. And again, it's worth spending time on because it is the number one reason why property investors don't succeed in their strategy. As I've mentioned, cash flow is the lifeblood of business. It's the lifeblood of property investment. It's the lifeblood of our own personal finances. So it's worth spending some time on. Now, look, if you haven't already and you feel happy to, please feel free to subscribe to my channel. That way you'll get informed when I upload new content. And if you can like the video, that way it'll also allow me to have a better understanding of the type of content people are wanting to view. So thank you again for sparing some time to watch this video, and all the best with your journey.